It's been a really very tough week actually for a lot of stocks. People are looking to sell strength in the broader market. A lot of the news we've seen towards media stocks, especially the domestic ones, has been relatively negative. I suppose the stock which has outperformed and will continue outperforming in my mind is News Corp. They've announced this week that in the last couple of days that their buyback of their $5 billion buyback is 95% complete. Once that's fully complete, obviously they'll look to do their next tranche of $5 billion, which will probably be complete somewhere, or they're aiming to complete it sometime in 2013. But the last 5 days the stock's down about 2% or so, still about above $21. If it gets down to about $20, then I'll probably be looking to buy the dips on that. Elsewhere, if you look at 10 still seems to be struggling very much so at the moment. It's trading around that sort of 46-cent mark. It's flat on the week over the last 5 days. There does seem to be a lot of talk, mainly from the Fin Review, that they're tying up, they're close to agreement with Champ private equity funds on the sale of their iCorp business. So perhaps we're going to hear more about that in the next couple of weeks and how that will feed through to 10's bottom line going forward. We know their costs are likely to ramp up because of the content that's going to be changing over there. Fairfax is another one which has had its fair share of the news recently. The stock still seems to be bobbling along very closely at the bottom. It traded down to 55 cents over the last couple of days, so currently about 56 cents at the moment, so still really looking quite like it's struggling. We did see ratings agency S&P suggesting their outlook was downgraded their outlook, and again it feeds into the argument that some people have that they're quite concerned about their debt covenants going forward. Elsewhere, CBA, Commonwealth Bank, came out of a note that was quite interesting. They said that Seven West Media is now fully factoring, and I've said it before, that they're factoring a $500 million capital raising at the moment. They've actually increased their 2013 cost growth to 8.4% from 4.5%, which they previously had. As a result, they've had to take down their 12-month price target, and it's currently sitting around $239. So, yeah, some modest upside going through there, but they believe that you'd probably like to see a $400 million capital raising at the least to address the debt covenant concerns that these guys have got. Interestingly as well, they talked about some positive stocks. They said Seek was their #1 choice at the moment. They said on a 1 to 2 year view, Seek was at a very, very compelling entry point. You've also got a situation where they said Southern Cross Media, ticker code SXL, which is actually down a touch for the week. I think it's down about 6% or so, 8% for the week, has said that that's their #1 pick outside of the ASX 200. They said that they've got limited balance sheet risk coming through. A lot of the earnings risk is priced into the stock at the moment, and given the fact that they make about 70% of their EBITDA from the radio, which is considered a very defensive earnings stream, this could be a very good place to be longer term. But the stock's down a touch this week as some of those macro concerns really hit sentiment.
Stay with us. Coming up on Media Week, we'll speak to the new editor of the country's biggest selling daily paper.